a broke loser. It is holy and magnificent. You need to buy my book on Amazon. And peace be with you, and also with you. Anyway, that was my book, Stop Being a Broke Loser. Go check it out. It's only $3 for an ebook on Amazon, and I believe it's $9.99 for a paperback. Not a hard copy, paperback. Anyway, welcome back to Strongman Personal Finance. My name is Christopher Bell. I'm a certified public accountant, long-term boglehead investor, author of the book Stop Being a Broke Loser, the one I just showed you, and a potential investor in Sam's stock, or the Boston Beer Company. Now, I am very, very biased about this stock. Why? Because I freaking love the beer, okay? Sam Adams is my default beer. Some days I want to have German beer. Maybe I'll have a Pilsner. Or is that Czech? I think that's Czech. Maybe I'll have a Pilsner. Maybe I'll have a wheat beer. I like having higher quality beers. But when I don't know what I want, or if I just want a standard, easy beer that's not expensive, it's delicious and perfect, I go with Sam Adams, just the generic Sam Adams beer. I freaking love it, okay? And when I heard about Jeremy LaFufu, y'all know who that is, pumping the stock, I had to look into it because maybe it's a buy. So what I'm going to do in this video is just do a live walkthrough. I'm going to go on the Everything Money software. I'm going to look on Morningstar. I'm going to go on the Boston Beer Company website. I'm going to look at their financial statements. We're just going to sit through this together and check out Boston Beer Company. At the end of the video, I'll try to give you an assessment of whether I'm going to buy it or not, because I really haven't made my mind yet. I haven't actually done the analysis. And the reason is because Morningstar is being stupid, and all that Excel sheet I used to be able to download, I can't download it anymore. It's freaking annoying. I don't know what they did with it. It's just gone. So I have to remake my whole model. Oh, I hate that crap. Anyway, let's share my screen, and let's go check out Sam's stock. So here's Boston Beer, ticker symbol SAM. Boston Beer Company engages in the business of alcoholic beverages. Its brands include Truly Hard Seltzer, Twisted Tea, I actually didn't know this, Sam Adams, which I drink, Angry Orchard, I didn't know that, Hard Cider, and Dogfish Head. Now, Dogfish Head is, every time I see that beer, I just always automatically think massive hangover, because that every time, or every brand of beer that's under Dogfish Head, it's like really high alcohol content. So I tend to avoid that type of beer because my tolerance has definitely decreased as a old 32-year-old man. Now, recently, Boston Beer has been freaking annihilated, okay? It was trading at a high, it looks like, of $1,300 per share. And now it's trading at $4.55 per share, a drop of 51%. Why did this happen? Mostly due to a slowdown in the seltzer industry. Boston Beer Company got into Truly Hard Seltzer, and there's so much competition, and their sales sucked so bad that it basically annihilated the stock. So maybe they got caught up in a craze of, oh my God, seltzer's the future, bro. And then they realized seltzer wasn't selling, or it was highly competitive. Then the stock freaking crashed. But that doesn't mean it's a bad stock. Another note. Just because the stock is $4.55 doesn't make it cheap or expensive, okay? The share price doesn't matter. It's the market cap of the company, and it's the amount of earnings you're buying with that share price. Now, I wish I could use Robinhood for like PE ratios and stuff like that, but it's just unfreaking reliable. So let me jump over to Fidelity and see if I can get a most updated, actually, let's go to that return on invested capital site. But if you don't know what this is a site I found. It's free, and it has a ton of financial data. It's pretty freaking cool. All right, here we go. So here's the Boston Beer Company. Recent price. Okay, the price looks accurate. PE 58. I mean, that's pretty freaking high for a company like this. The PEG ratio is below 1 though, so that's actually an encouraging sign. So pretty expensive PE doesn't necessarily mean it's a buy or not. I mean, if it's a fast growing company, maybe the PE is justified, but it's still that kind of makes me hesitate when I see that. Okay. Sales per share. So we can see the change in sales per share. I mean, this company is growing pretty freaking quickly. It went from starting in 2018, 115 to 140 to 140. Well, they had a slowdown in 2020, duh. And then over the last 12 months, 177. So they're growing pretty freaking fast, okay? Earnings per share has also grown until very recently, where it's dropped actually by half. And the reason that's happened is a lot of charges and write-downs due to issues in the seltzer industry, which I think may be temporary. Okay. Common shares outstanding. They did have a pretty massive share issuance pretty recently. They went from, I don't know, maybe 9 billion shares, I don't know, 9 something shares to 12. So that's an increase. So they diluted their shareholders by 33% in 2020. I guess they needed that to survive, but still, it's pretty freaking crazy. PE, trailing PE, or this is the average annual PE. 58 over the last 12 months, and it's been a way lower. So, man, I don't know. That's pretty freaking crazy. Operating margin, pretty consistent. I mean, some fluctuations and then a massive drop. So basically, over the last 12 months, they've been hit pretty freaking hard, which is why the stock has crashed by half. Operating margins fell by almost, 66%. Net income fell by over 50%. I can totally see why this stock got freaking annihilated. But the question is it temporary or is it not? Now, let's go look at the website. So just so you're, just to give you an image or an idea of what they do. If you've ever seen this beer brand, which I love it, it's so good. This is what I drink. This is what they sell, okay? This is like their flagship beer. The standard Sam Adams Boston Lager. Freaking delicious, okay? Dogfish. This looks like, I think this was an acquisition they made. Way too high alcohol content. Truly Seltzer, this is where the issues have been coming in because the seltzer industry is so freaking competitive and they basically had a lot of issues, turning inventory. So, I mean, we'll see that. They'll discuss it more in the financial statements. Angry Orchard, it's for soy boys and liberals and girls. Hard cider. Coney Island, Angel City, Havana Lager. Man, they got a lot of stuff that I've seen, but had no idea was actually associated with Sam Adams. The more you learn when you research a company, okay? Now, let's go look at their most recent quarterly statement. This is the 10Q for the quarter period ended September 25th, 2021. And let's go directly to management's discussion and analysis. So, why did this stock get annihilated? Slowdown of hard seltzer category impact. The 13 weeks ended September 25th results include direct costs resulting from the slowdown of the hard seltzer category of $102 million. These costs, so this affected their bottom line because they had to write down inventory and they had to impair some of their assets. These costs included inventory obsolescence, estimated destruction costs, good, seltzer's trash, and other inventory-related costs of $53 million. Contract termination costs, primarily for excess third-party contract production, I guess all that's related to seltzer, and equipment impairments of $12.7 million. So they got a $100 million hit just from freaking seltzer, okay? The total direct costs have been recorded in the 13 weeks as a $53.5 million increase in cost of goods sold. So they're basically moving their costs depending on, where it fits in better. $35.4 million in contract termination fees and $12.7 million in impairment of long-lived assets. So seltzer pretty freaking annihilated them. But even then, even with that seltzer annihilation, the soy boy liberal girl drink, net revenue increased by $68.9 million or 14% for the 13 weeks ended September 25th, 2021, as compared to $492.8 million for the 13 weeks ended September 26th, 2020. So even then, with the seltzer getting annihilated, they still growing their revenue pretty significantly. I don't know if a PE of 50 something justifies a 14% growth rate, but we'll plug in the numbers. So net revenue per barrel, that's gone up, pretty slightly. Cost of goods sold has increased, which you want cost of goods sold to be as low as possible because that's a business expense. So there was an increase in cost of goods sold, primarily due to $84.3 million direct and indirect volume adjustment costs as a result of hard seltzer slowdown. So even if they have bad gross margins, that might be temporary. It's only about the hard seltzer. And higher material costs. I think everybody's having that trouble. Okay, partially offset by price increases. So interesting. Okay, so let's go look. I mean, they really go deep into the barrels. Bring out the cost of the barrels. Let's see the financial statements. Come on. Where you at? Here we go. So we'll start with the balance sheet. So with the balance sheet, you can just look at their current ratio. You can look at their debt to equity ratio. I mean, they kind of tell you like liquidity and leverage metrics. So you look at their total current assets for September 25th, 2021. They have 431. What is that? Million? 431. No, that's $1 million. And their total current liabilities are 285. However, a lot of their current assets seem to be in inventories. So if you actually do the quick ratio, which is cash equivalents, accounts receivable, and marketable securities, and maybe income tax receivable, we'll include that to be nice. You divide that by their current liabilities. They actually have a quick ratio below 1, which may be concerning, or maybe it's just part of, maybe that's pretty typical for their industry, but you want to keep that in mind. So even if the current ratio looks good, you have to actually look a little bit more into it and say, okay, well, what is driving up current assets? In this case, it's a lot of freaking inventory. Okay. Debt to equity ratio, you just take total liabilities divided by total stockholders' equity. Looks like it's less than 0.5, which, isn't that bad. All right. The income statement. Let's look on the right here. The 39 weeks ended September 25th, 2021. So we had revenue of $1.8 billion, less excise taxes. That's the government. Minus cost of goods sold. Gross profit of $698,015. So gross profit as a percentage of net revenue was 40%. Good. Let's see how it was last year, or over the last 39 weeks last year. 598, 182 divided by 1275, 495. So yeah, they've had almost a 7% drop in gross profit. But like I said, that might be temporary. So I wouldn't worry about that too much if you're looking at buying into this company. Okay. Operating income, way less this time over the last 39 months than over the previous year. So they've definitely been hit pretty freaking hard, which is why their stock has collapsed. But even then, they still have profitability. So I wouldn't worry about it. Now, over the last 13 weeks, they've actually had a net loss. A big part of that was contract termination costs and impairment of assets. But even if you exclude these two temporary one-time expenses, they still have a net loss. So I don't know if they're spending way more on advertising, promoting, and selling expenses or what's going on there, but you'd have to investigate that more. Because, I mean, it's not as big of a deal if you have a temporary one-time, cost that results in the company having a loss. But in this case, I mean, even if you factor out the contract termination costs and the impairment of assets for the seltzer, they would have still had a loss. So keep that in mind. But I think they're going to recover, in my personal opinion, because the beer's just so good. I'm so biased. Cash flows. So they actually got hammered pretty freaking bad with operating cash flows, okay? The income statement tells one story. The statement of cash flows tells another. At least they're still cash flow positive on an operating standpoint, but it's decreased by 75%, it looks like, from last year. So they've been really freaking hammered. The question is, going forward, can they recover? We'll see. So that's that. Now, let's go to Everything Money. And we're going to use their software because, like I said, stupid freaking Morningstar. I made this model. I had pictures of Meet Kevin with a clown nose, and I had Jeremy LaFufu. I had all these people on there. And I had this beautiful model, and I would just copy the Excel sheet and put it into, put it in there. And then, boom, I could do my analysis. But, of course, Morningstar got rid of their key ratios Excel sheet. I don't know freaking why. And now I can't do that. So I have to remake my model. So I'm pretty freaking pissed. Anyway, let's look at Sam Adams. So we can do a quick scan of the metrics. Okay. PE, pretty freaking high, 53. PE over the last 12 months. Well, that's an average PE. Over the last 12 months is 84. Holy crap. Gross profit. Ooh, I calculated that. 40.8%. Profit margin, 3.9%, which I think it should be higher after all these, random charges and bad times. So you can see this company had a massive run-up. I mean, that's clearly unsustainable. I mean, a run-up like that generally doesn't sustain itself. It has some kind of correction because most companies don't grow that fast. 8 pillars, shares outstanding. Yeah, they diluted a little bit. They diluted way more than that. during the pandemic. They don't have a lot of debt, cash flow growth. Yeah, they've been freaking hammered, So a lot of this looks bad, but I think it's a temporary thing based on seltzer. I mean, why would you get into seltzer? Okay. It should be a manly stock with manly beer. So let's do some assumptions. Let's say it's 5 years, and we'll just do low and high because I don't have time for all three. So when you're looking at everything money, you can't really factor in, some of these revenue assumptions. I say you always do a supplementary source, which Morningstar does have some stuff, but it's just freaking jacked up. Like, I don't know what they did. Like, this whole website's just freaking destroyed. I'm so pissed. So here they have key statistics, which I can't download anymore, but they have revenue growth year over year. Okay. They have 3-year average, 10-year, 5-year average, 10-year average. So over, let's say the 5-year average is 13%. The 3-year average is 26, and the 10-year average is 14. I want to be conservative. I'll say low end 10% revenue growth going forward. Actually, let's be really conservative. Let's say 7% revenue growth going forward. And we'll say on the best case, 14% revenue growth. Profit margin, let's see, net income, 5-year average, 14%, 10-year average, 14, 3-year, 25%. Now, these metrics almost don't seem like they're right. I mean, we could go with like 8, 10, and 12 because I don't really, let's do 8 and 12. I don't really trust Morningstar right now. There's something really freaking wrong with this, which is annoying, It can't be easy, everybody. It can't be freaking easy. Free cash flow margin. Let's go to cash flow as a percentage of sales. Okay. 11, 9, 5, 6. I mean, we could maybe say 6.5 and 10 for low and high. PE. Now, the PE, I think, is kind of freaking ridiculous. Okay. I would say it needs to be, maybe low end 20 because it is kind of a faster growing company. High end 30. Price to free cash flow. We'll just say the same thing. And then I want a 15% return. Let's see. Ooh. So it's actually, I mean, if I had the third assumption, it would be right in the middle. I mean, this is a pretty low amount of revenue growth. It still is something you should factor in, 7%, because in that case, it's definitely not a buy. But if you believe these high assumptions, 14% revenue growth, 12% profit margin, 30 PE, I mean, maybe that's a little rich, and you want a 15% return, it's not bad. Let's see 10%. Yeah, I mean, I don't know. I'd have to do more research. I really want to tighten my shot group with some of the numbers because Morningstar just freaking threw all my analysis out for a loop. So I have to remake a model and really go more in depth into it. But this company definitely is on my watch list. Like, I'm definitely going to consider buying it. And if I do, I'll definitely let you know. But remember, I don't put a lot of money in individual stocks. I'm a VT index person. All right, let's check the comments. All right. Morning, strong man. Happy Thanksgiving. Thank you. Hey, Harker. What's up, bro? If Lufufu's in it, bro, might be losing hella money. I know this is one of the few stocks that Lufufu has some kind of logic behind. I mean, he just saw it drop probably. Well, it dropped and stocks go up, so if I just buy it, the dip, it's gonna go up or something like that. But I don't know. I like the beer. I'm kind of biased, but you can do your own analysis. Sam is on my watch list. We probably bought it on fundamentals, but they have Truly, so it's a buy. Yeah, Truly's the future. Seltzer for soy boys is the future. I think management revised their guidance for 2021 during Q2. Yeah, I mean, YOLO. I definitely have to do more research on this. I love your vids of crapping on you, but these financial breakdowns are really great. Thank you. Yeah, I tried this new thing. I was like, I'm not even going to look at it. I'm just going to pull it out of my butt and then, just go live. People like it, great. If not, then I'll just, record it on my own and, upload it with a little bit more editing. Good morning. At the bars and restaurants, there are so many new microphones. I believe people just want to try the new thing on tap. Sam's just sits along. Yeah, I don't know. But they still have pretty good revenue growth. I mean, even after getting annihilated, they're still growing their revenues. They just need to get rid of that stupid seltzer. I would like to formally request Facebook and LMT analysis. I'll do it. Mr. Hero, good morning. I just checked out your ROI tool page. It's great. Yeah, I might have to build my model based on that. And then, of course, that website's going to go down. So I can't use that. Such a pain. Investing in individual stocks is a pain. So I wonder why you always make fun of LeFou. So I actually tried watching him yesterday. Lost a brain cell. He's a freaking moron, which is why he has 700,000 subscribers. That's how YouTube works. The dumber you are, the more subs you have. I guess I'm getting dumber the more subs I get. Good morning. Every bar, there are so many new different breweries with new flavor. Everyone orders a thing. Sam, did I just click on that? Yeah, I think you posted that twice. Great content. Thank you. Like, subscribe. Sup, bro? What's up? Fufu's voice is annoying. Yeah, I'm going to start making more LaFufu hate videos. I have fun with that. And then do a PayPal analysis. I will. Anyway, that's it. You do more research. I mean, it seems intriguing. I might consider it. I don't know. But if I do, I'm only going to put like $500 or $1,000 into it. I don't like putting a ton of money in individual stocks. I have a ton in Baba, which is getting wrecked. I don't care. But basically 96% of my portfolio is in the Vanguard Total World Stock Market Index Fund, ETF. So that's that. Anyway, talk to y'all later. Cheers.